Credit cards versus debit cards. Which one should you use? For the longest time, I actually didn't know the difference between the two. When I was in college, my friends would hand me their credit card so I could pay for my portion of the bill at the end of our night out. And then I would just assume that they were paying me back by transferring money over to me through their bank account. But it turns out we were all wrong. After reading about both types of cards, there are some advantages and disadvantages that you need to know before getting either one. Let's start with credit cards first. A credit card is essentially a loan that you're able to access on a daily basis. So anytime you swipe or tap your card, what you're really doing is borrowing money from the bank to make that purchase. The thing is, you don't have unlimited spending power. Instead, you have something called a credit limit. This is basically the maximum amount of money that you can borrow. Your credit limit depends on many factors, including your income, debt, and credit history. If you want a higher limit, you may have to wait until you establish yourself with the company, aka become a loyal customer, or you can call and ask for a credit limit increase. Now, since credit cards are technically loans, there are interest rates involved. In most cases, banks will offer a 0% introductory rate for new cardholders for a limited amount of time, which means that you can borrow thousands of dollars interest-free for anywhere between 6 months to 1 year. After that promotional period ends, the interest rate will be significantly higher unless you're approved for a balance transfer. Balance transfers are when you move your existing debt from one credit card to another. And the best part is that you can typically avoid paying any fees. If you do this within the first year of owning the card, if you're interested in learning more about balance transfers, I made an entire video on it, so make sure you check that out afterwards. Anyways, going back to interest. If you carry a balance month to month, then you will get charged interest on the total amount you owe. It's important to make at least the minimum payments on time every single month so that you don't get charged late fees or ruin your credit score. Otherwise, you'll start snowballing debt, and before you know it, you'll be in a position where you can no longer afford to make those minimum payments. So please, do not spend more money than you can handle. And yes, I understand that credit card companies are trying to trick us by offering rewards like points and cash back. But please, take responsibility for your actions. Because if you get into debt, it's going to be very difficult to dig yourself out of it. If you are currently in debt and need help creating a budget or negotiating with creditors, let me know down below in the comments section, and I'll share some resources. Alright, now, moving on to the topic of credit scores. Pretty much everything in life revolves around them. Whether you're buying a car, house, applying for jobs, renting an apartment, or even signing up for utilities. Most people don't realize this, but your credit score actually gets pulled every single time you apply for anything, so it's in your best interest to make sure that it stays high. Here's how it works. You'll notice that I mentioned earlier how making those minimum payments on time is super important. Well, payment history makes up 35% of your credit score. That means that if you miss one payment, you will get dinged. Now don't worry, you won't, and get dinged if you make a late payment by 1 or 2 days, because those grace periods do exist. But if you consistently make late payments, you'll start to notice your score go down, which can result in higher interest rates. That being said, never call your credit card company and ask them to report that you paid off a balance, because that will lower your credit score. See, here's the logic behind it. They want to see consistent on-time payments, not zero balances. So while it might seem logical to lower your score right away, it actually hurts you in the long run. Now let's talk about debit cards. With a debit card, you're directly accessing your own funds. So anytime you swipe it, the money is immediately deducted from your checking account. So unlike credit cards where you're borrowing money with a debit card, you have to have the money already available. One of the biggest differences between these two is that with a debit card, there are no interest rates or credit checks because you're not taking out a loan. However, there are still fees that you have to look out for. Typically, banks will charge a monthly maintenance fee if you don't meet certain requirements. Requirements usually involve having a minimum amount of money in your account, direct deposits, or a certain number of transactions each month. There are also ATM fees whenever you withdraw cash. If you use an out-of-network ATM, you'll have to pay a service fee on top of the transaction fee from the ATM owner. So it's always good to check your card's fee schedule, so you know exactly what you're getting yourself into. On top of that, if you use your debit card to make a purchase and get a receipt, you'll also be charged sales tax depending on the state you live in. Sales tax rates vary throughout the country, and it will appear on your credit card statement about a week later. The only way to avoid sales tax is to shop online and not receive a physical receipt. In terms of security, the cool thing about credit cards is that you're only liable for the first $50 of unauthorized charges. That means if someone steals your credit card and goes on a shopping spree, you owe and be on the hook for the full amount as long as you report it right away. On the other hand, debit cards do not have the same protections. If someone steals your debit card, they can easily drain your entire bank account. I know this because it happened to me once. Some guy stole my mom's purse when she wasn't looking, and it had my debit card inside. He went on a shopping spree buying Apple gift cards and drained my entire $700 balance in a matter of minutes. Needless to say, I was very upset. So, to protect yourself, you can turn on transaction alerts on your phone, and that way you know right away if something suspicious happens. So now that we covered all the individual components of each card, the next question is, which one should you use? Well, in general, it's best to use a combination of both. From my experience, here's what works for me. First, I keep enough money in my checking account to cover 3 to 6 months of living expenses. I use my debit card for every single purchase, and that way I know I'm only spending what I have. For credit cards, I keep a small balance on each of them, so I can quickly pay it off and earn points. This is also called a credit card trick. If you want to learn more about it, I have an entire video on it, so make sure you check it out. Anyways, if you've made it this far, congratulations, because you've officially learned how to become financially literate. You are now certified to impress your friends and family members when they ask you what you do for work. Thank you guys so much for watching. If you found this video helpful, please hit the like button and subscribe. Also, if you have any questions, feel free to comment down below and I'll try my best to answer each and every one of them. And finally, I want to give a huge shout out to all my supporters who help make videos like this possible. If you want to support, please click the link down below. Hope you have a great day, and I'll see you next time.